Okay, so you want to buy a private jet. Find the right model, sign the check, fly wherever you want, whenever you want. No lines, no layovers, no stranger's elbow on your armrest. That's the picture in your head. Owning a piece of the sky. The rest of this is what actually happens once that picture becomes a real airplane sitting in a real hangar with real bills attached to it. Let's start with the part everyone gets wrong before they even open their wallet. People assume the sticker price is the hard part. It isn't. The sticker price is just the entry fee. The real cost of a private jet is what happens every single day after you've already paid for it. First, the entry fee itself, because even that has layers most people never think about. At the bottom of the market sit the very light jets, the smallest category that still counts as a real business jet. These start around $3 million and top out somewhere around $7 million. They carry maybe 4 to 6 passengers and are built for short regional hops, an hour or two in the air at most. Step up from there and you land on light jets, roughly $8 million to $16 million. Then mid-size jets, which run $16 million to about $25 million. These are the aircraft with a cabin tall enough to stand up in, which sounds like a small detail until you've spent 4 hours hunched over in a smaller plane. Above that sit the super mid-size jets, $26 million to $38 million, built for coast-to-coast flights without stopping. Then large cabin jets, $40 million to $62 million. And at the very top, the ultra-long-range jets, the ones built to cross oceans without landing, priced anywhere from $65 million to over $80 million. A small number of even larger aircraft, the VIP airliners built from converted Boeing and Airbus commercial jets, can run past $100 million, sometimes well past it. So already you can see the problem. The word private jet doesn't describe one purchase. It describes a 6-step ladder, and the bottom rung and the top rung are separated by a gap of roughly $80 million. Most people picture the top of that ladder. Most people can only justify the bottom of it, if that. But here's the thing nobody tells you when you're looking at that price tag. The purchase price is not really the price. It's the deposit. And before we even get to running the plane, there's a second trap door hiding underneath that purchase price, one that has nothing to do with flying it at all. The moment a new jet leaves the factory, it starts losing value. Industry estimates generally put first-year depreciation at somewhere around 10 to 15% of the purchase price. On an $80 million aircraft, that's $8 to $12 million gone in the first 12 months alone, before a single mechanical problem, before a single bad year of usage. After that first steep drop, the curve flattens out, usually settling to around 5% a year through years 2 to 5. Smaller jets tend to depreciate faster than larger ones in percentage terms, partly because there are simply more of them on the resale market competing for the same buyers. The most popular light jet in the world can lose around a third of its value in just its first 5 years. That's not a flaw in any particular aircraft. That's simply what happens to a machine the moment buyers know a newer, slightly better version is coming next year. This is why experienced buyers often deliberately avoid new aircraft entirely, and instead target planes around 6 or 7 years old, aircraft that have already absorbed the steepest part of the depreciation curve, but still have a decade or two of useful flying life left in them. A 7-year-old mid-sized jet can sell for around half of what it cost new, while still being airworthy for another 20 years. The lesson sits quietly underneath all of this. A private jet is not an investment in the financial sense. It's a depreciating asset you happen to be able to sit inside. Nobody buys a jet expecting to sell it later for more than they paid. The only question is how fast you lose the money, not whether you lose it. Let's talk about what it costs just to keep the thing sitting on the ground, doing nothing. First, the hangar. Renting covered space for your jet runs anywhere from $1,500 a month at a quiet regional airport to $10,000 a month or more at a premium hub like Teterboro in New Jersey or Van Nuys in California. Add it up over a year and you're looking at $18,000 to well over $100,000. And that's before the plane has gone anywhere. Second, insurance. This isn't optional, and it isn't cheap. A small light jet might cost $10,000 to $25,000 a year to insure. A large cabin or ultra-long-range jet, the kind worth tens of millions of dollars, can run $200,000 a year or more, sometimes climbing toward $500,000 depending on the coverage and the pilots flying it. Third, the crew. This is the cost people underestimate the most. A jet needs at least one pilot, usually 2 for anything beyond the smallest aircraft, and larger jets often carry a dedicated flight attendant as well. Pilot salaries alone range from around $86,000 a year for less experienced crew up to $300,000 or more for senior captains on the largest aircraft. Put a 2-pilot crew together, add training, medical checks, and benefits, and you're easily spending $200,000 a year just so qualified people are available to fly your plane, whether you use it or not. Fourth, maintenance. This is where the bills get genuinely frightening. Routine maintenance alone typically runs 5 to 10% of the aircraft's total value every single year. On a $20 million jet, that's $1 million to $2 million annually just for scheduled upkeep. Aircraft maintenance is organized into checks, lettered A through D. The A and B checks are routine and happen every few hundred flight hours. The C and D checks are deep structural inspections, the kind that can ground your aircraft for weeks at a time, and a single D check can cost more than $500,000 by itself. And that's before anything breaks. A single replacement tire for a large jet can cost over $2,000. A new wireless internet system installed in the cabin can run past $500,000, plus another $100,000 for the antenna housing. Reupholstering the seats alone can cost $200,000. Replacing the cabin carpet runs $40,000 to $90,000. Refinishing interior woodwork can run $300,000 to $500,000. None of that is exotic or rare. That's just what it costs to keep a 40-year-old design of aircraft looking and flying like new. There's also a fifth category that owners often forget to budget for entirely: management. Most owners don't personally handle scheduling, crew hiring, maintenance tracking, and regulatory paperwork themselves. They hire an aircraft management company to do it, and that service alone typically costs $50,000 to $200,000 a year, layered on top of everything else. It's the cost of having someone else worry about all the other costs. So let's stack it up. First, the hangar. Second, the insurance. Third, the crew. Fourth, the maintenance reserve. Add those four categories together, even before the plane leaves the ground for a single flight, and you are commonly looking at $500,000 to over $1 million a year just to own the aircraft and have it ready to fly. Now here's the trap. Someone finds a beautiful deal. A pre-owned jet, 10 years old, priced at half of what it would cost new. Sounds like a steal. Well, almost. Here's the problem. An older aircraft hasn't avoided maintenance, it's just deferred it. The closer a used jet gets to its next major inspection, the more that discount evaporates. Buyers who skip a proper pre-purchase inspection on a used jet can find themselves staring down a single maintenance event, a major engine overhaul, or a structural D-check that costs more than the discount they thought they were getting in the first place. The deal that looked smart on paper becomes the same price as buying new, except now you also own an aircraft that's 10 years closer to its next big bill. Now let's actually fly it, because flying is where the real money starts moving. Every hour a private jet spends in the air costs money beyond the fixed expenses we just covered. Fuel alone runs roughly $1,100 to $2,700 per flight hour, depending on the aircraft's size. A large jet burns through hundreds of gallons of fuel every single hour. Layer on crew costs, maintenance reserves tied to engine hours, landing fees, and in-flight catering, and the total cost to fly most private jets lands somewhere between $2,000 and $10,000 per flight hour. All in, let's do that math out loud, because the number that comes out the other end is the one that actually decides whether owning a jet makes financial sense. Say you own a mid-sized jet. Your fixed costs, the hangar, insurance, and crew, run around $700,000 a year before you've flown a single mile. Now you fly at 200 hours that year, a reasonably active travel schedule. At an average all-in cost of around $3,000 per flight hour, that's another $600,000 in fuel, maintenance, and fees. Total cost for the year, roughly $1,300,000. Divide that across your 200 flight hours, and each hour you spend in the air actually costs you around $6,500. Once you include everything, compare that to chartering. A mid-sized jet charter runs somewhere around $5,000 to $10,000 an hour, all-inclusive, with no fixed costs at all when the plane isn't flying. Suddenly, the math gets uncomfortable. Unless you're flying enough hours to spread those fixed costs thin, owning starts to look like the more expensive option, not the cheaper one. This is the asymmetry at the center of jet ownership. The costs are fixed. The usage is not. You pay for the hangar, the crew, and the insurance whether you fly 50 hours a year or 500. The only way ownership beats chartering is volume, and most owners simply don't fly enough to get there. Industry estimates generally put the break-even point somewhere around 150 to 200 flight hours a year. Fly less than that, and you are very likely paying more per hour to own the plane than you would to simply rent someone else's. And even that math assumes fuel prices stay roughly where you expect them to. They don't. Jet fuel is bought on a global market, the same market shaken by wars, refinery shutdowns, and shipping route closures. A conflict that closes a major strait or disrupts a key oil-producing region can send jet fuel prices sharply higher within weeks, sometimes doubling compared to the year before. For an owner whose biggest variable expense is fuel, that kind of swing doesn't just raise costs, It can wipe out the entire margin between owning and chartering in a single bad year. This is the part of the math that no brochure will show you, because it isn't a fixed number. It's a number that depends on geopolitics you have no control over and cannot predict when you sign the purchase agreement. So how do owners try to fix this math? The answer is they try to make the airplane work when they're not using it. The most common method is chartering it out. When the owner isn't flying, a management company lists the aircraft for charter to other clients, and the revenue helps offset the fixed costs. This is why so many private jets you see for charter online are technically privately owned. The owner isn't running a charter business. They're trying to make their own ownership math survive. The trade-off is where. Every charter hour put on the aircraft is a charter hour closer to its next major inspection and a faster climb up the maintenance cost curve and faster depreciation on resale. So owners have to weigh the charter income they're collecting today against the resale value and maintenance bills they're accelerating for tomorrow. It's rarely a clean trade. A second method is fractional ownership, the model where instead of buying a whole aircraft, you buy a share of one, paying for a guaranteed number of flight hours each year, while a management company handles the crew, maintenance, and scheduling. This model didn't always exist. It was invented in the late 1980s by a mathematician and former investment banker named Richard Santulli, who ran the numbers on pilot logbooks and realized that most jet owners were only flying their aircraft a fraction of the time it sat available. His solution became the company NetJets, the first business in the world to sell fractional shares of private aircraft instead of whole planes. A third method is the jet card, where instead of owning any part of an aircraft, a customer simply prepays for a set number of flight hours at a locked-in rate, with none of the ownership risk and none of the ownership upside either. Now let's talk about who actually owns these things, because the answer is more varied than most people assume. Large companies often own jets not as a luxury but as a working tool, because an executive who can visit 3 clients in 3 different cities in a single day generates more value than the cost of the flight. Wealthy individuals own them largely to buy back time that would otherwise be lost to layovers and security lines. Governments use them for secure transport. Professional sports teams use them for travel logistics around tight game schedules. And charter companies, along with aircraft management firms, own and operate fleets specifically to generate revenue from other people's flying. There's also a quieter reason private jets get bought, one that rarely makes it into the glossy brochures: the tax code. In the United States, an aircraft used primarily for business purposes can qualify for what's called bonus depreciation, a provision that, under current law, allows an owner to deduct the entire purchase price of the jet against taxable income in the very first year it's placed into service. For a business owner sitting on a large taxable profit, that single deduction can offset millions of dollars in tax liability in one stroke. This is part of why so many jets are registered to companies rather than individuals, and why so many purchases happen near the end of a particularly profitable year. The plane is still genuinely expensive to operate, the depreciation, fuel, and crew costs are all still real, but the first-year tax benefit can meaningfully soften the blow of that initial purchase price, turning an $80 million decision into something closer to a $50 or $60 million one once the tax savings are accounted for. It's worth being honest about this because it means a meaningful share of private jet purchases are driven as much by a company's year-end tax position as by any pilot's flight schedule. Here's where the story of Warren Buffett and NetJets is worth knowing, because it's one of the most honest examples in business of just how unforgiving this math can be. Even for someone considered one of the most disciplined investors alive, Buffett became a NetJets customer himself in the mid-90s, flying as a fractional owner for a few years before deciding the business itself was worth owning. In 1998, his company Berkshire Hathaway bought NetJets outright for $725 million, about half of it paid in stock. At the time, it looked like a natural extension of a business empire built on understanding cash flow better than almost anyone else on Earth. But here's where it gets interesting. For years afterward, the jet business lost Berkshire money, year after year, even as customer satisfaction stayed high and the fleet kept growing. In his own annual shareholder letters, Buffett later admitted that NetJets had at one point become his single biggest financial worry inside the entire Berkshire empire, that its costs were running far out of line with its revenue, and that cash was draining out of the business so badly that without Berkshire's enormous balance sheet behind it, NetJets would have gone broke entirely. So how does the world's most famous value investor, a man who has spent decades finding businesses with simple, durable economics, end up running a company that nearly sank under its own weight? The answer isn't that he misjudged the idea. Fractional ownership was, and still is, a genuinely useful innovation. The answer is structural. Jet ownership of any kind, fractional or otherwise, is a fixed-cost business riding on top of unpredictable demand. Crew, maintenance, hangars, and aircraft all cost money regardless of how many hours customers actually want to fly in any given year. When demand dipped or competition forced prices down, those fixed costs didn't move, and the gap between revenue and cost turned into exactly the kind of cash drain Buffett described. It eventually stabilized years later under new leadership that brought costs back in line with revenue. But the lesson stands on its own. If the difficulty of this business could quietly threaten to bankrupt a division inside Berkshire Hathaway, the math is not friendly to amateurs. Keep that in mind if you ever think owning a fraction of a jet sounds like the easy version of this dream. Now let's put two real scenarios side by side, because this is the part that actually tells you whether buying a jet for yourself ever makes sense. The optimistic scenario. You buy a mid-sized jet for $20 million. You fly it consistently, around 300 hours a year, which is a genuinely demanding travel schedule, the kind that belongs to a busy executive who is in the air several times a week. Your fixed costs run $700,000 a year. Your variable flying costs, at roughly $3,000 an hour for 300 hours, add up to $900,000. Total annual cost, $1,600,000. Spread across 300 hours, that comes out to a little over $5,300 per flight hour, which is genuinely competitive with chartering a similar aircraft. At this level of usage, ownership starts to make real financial sense, not because the jet is cheap, but because the fixed costs finally get spread thin enough to matter. Now the realistic scenario. You buy the same jet, but your actual travel needs are more typical. Somewhere around 100 flight hours a year, the kind of schedule most successful business owners actually have, busy but not constantly airborne. Your fixed costs stay the same, $700,000. Your variable costs drop to around $300,000 for the year. Total cost, $1 million. But now divide that across only 100 hours, and your real cost per flight hour jumps to $10,000. Nearly double the optimistic scenario, and well above what chartering the same aircraft would have cost you for those same 100 hours. The difference between the optimistic scenario and the realistic one isn't a rounding error. It's roughly $5,000 per flight hour. Multiply that across 100 hours of flying, and the gap between flying enough to justify ownership and flying a normal, busy schedule is worth around $500,000 a year, money spent or saved purely based on how many hours you actually use the thing you bought. And here's the uncomfortable comparison most owners avoid running. If that same person flying 100 hours a year had simply chartered a similar mid-sized jet instead, at a typical all-in rate of somewhere between $5,000 and $10,000 an hour, their total annual flying cost would have landed somewhere between $500,000 and $1 million. Compare that to the $1 million they actually spent owning the aircraft outright, and the supposed advantage of ownership quietly disappears. They paid roughly the same amount, sometimes more, for the privilege of also carrying $20 million of depreciating asset risk on their balance sheet. The plane didn't make their travel cheaper. It just moved the same cost from a clean hourly rate into a much messier collection of fixed bills, insurance premiums, and resale uncertainty. That's the number that should sit in your head longer than the purchase price ever does. Not the $70 million headline number for the airplane itself, but the simple fact that the airplane only makes financial sense once you're flying it enough to outrun its own fixed costs. Buy it for status, and the math will eventually find you. Buy it because your calendar genuinely needs it, run the hours, and run them honestly, and the math might just work in your favor. A private jet isn't really an airplane. It's a machine for converting money into hours nobody else can buy back for you. For most people, that's a bad trade. For the small number of people whose time is worth more per hour than the jet itself, it can be the best trade they ever make. The only question that actually matters is which one of those two people you really are before you sign anything.